Videos.
Video. Now, just check. Not yet, please. Yeah, it's all done. Yeah.
Hello, good evening. Hope I'm audible.
Yes, sir, you are audible, sir. Shall we start? Hi, sir. Sir, shall we? Sir? Yeah. Just a second, sir. Good evening, everyone. At Access Security, we are committed to promoting awareness of informed investment practices. To further this mission, we host regular webinar with the market leader who share market insight and guide our investor in making informed decision by addressing their queries. Continuing our program, we are excited to welcome Mr. B Gopkumar, the Managing Director and CEO of Access Mutual Fund, as our esteemed guest today. With nearly 3 decades of experience in finance industry, Mr. Gopkumar has excelled in roles spanning sales, distribution, marketing, and branding. Prior to this, he was MD and CEO of Access Securities. Before that, he has chaired leadership role at several reputed firms, including Reliance Securities and Kotak Group. He passionately believes that technology-driven solutions are imperative to empower investors and partner to unlock the true potential of Indian financial services landscape. He is an MBA graduate from Mangalore University and participated in senior leadership program at Harvard Business School. Outside of his professional pursuits, he is an avid reader and passionate marathon runner. Please join me in welcoming Mr. B Gopkumar. Sir, over to you.
Thank you, Samir. Thank you so much, and good evening, all my clients. It's a privilege for me to be part of this session. There are two reasons for that. One reason is that I was 1.5 years back was MDC of Access Securities. One of the reasons why I signed up for this session is just because I was been MDC or so. I thought that it's a time for me to have a communication with the clients. I do see a couple of names which I know personally. I see the names in this session, and thanks for joining us. What I'll do is that I think we have four large things we will speak today. I hope I'm able to communicate. I hope people can see the PPT. Samir, I can only see a smaller version of this, so I just wanted to be clear that hope all our logins are able to see that presentation. I'm not sure about it. Please check that. The quick ones, we will cover the four large things. One was one to look at how does the India macro looks like. How is the long-term story of India is intact and how it is stacking up. What is the way forward for Indian capital markets and strategies in these type of markets, and we do believe that asset allocation is one way to look at it. So we will speak about four large points. More importantly, I will also not covering a presentation on the global macros, but I think we will speak about it on a consequent slide on this. So let's go to the next slide. The theme of this talk is on the opportunity for long-term investors. We are very clear that we want to make a distinction because I'm in a brokerage platform. where there are traders, but I don't address the trader community. After moving to an asset management company, I think we will talk about long-term investing and what should the investor should look like going forward. So going through Indian macros looks very strong footing. Coming to next slide, I just wanted to spend a few minutes on next slide is on the robust macro backdrop. If you look at all the five components, what we are talking today, we have a very resilient growth, stable currency, lower twin deficits, inflation is under control, and robust corporate earnings. When we look at this, all the five macros today, the way it is, we are looking like an extended Goldilocks scenario. So there are debates that when you look at from a quarter on quarter, you may see some different thought around all these five components. But I think from a longer term perspective, we do believe that India is witnessing an extended Goldilocks scenario, especially post COVID. I think, for example, when you look at the corporate earnings. Corporate earnings for last 3 years was about 12 to 15%. But we can debate about what happened last quarter and what are we looking at. I think we still have some question marks around earnings. But from a longer term perspective, we do believe that the corporate earnings should stack from 12 to 13% from a Nifty companies. So when you see that, typically you will see that you can add 3 or 4% premium. So if you ask me from a longer term perspective, equity as an asset class can generate 14 to 15% returns. Answer is yes. Another conversation what we do most of the time when we look at earnings is that how does the earnings stabilize and how does the market view from the earnings perspective. So when I said that 15 to 16% is what we need to look at, above that technically you will find froth in the system. And so whenever you see corrections, you come back to this return of 15 to 16%. I think you are a witness maybe 3 or 4 trading days that the markets do correct. And one point I want to make it very clearer is that the markets are markets depends on earnings. I think if the earnings doesn't catch up, we still have a problem in terms of where the market looks like going forward. So, for example, Q1, when you look at the corporate earnings estimated was only or actual was around 6-7%. The market expectation was on a double-digit number. So, market actually, as first quarter, has accepted saying that X of bank, it looked like a double-digit, but what is important for us is to look at Q2 earnings. So if you look at recent corrections is also because of looking at and saying that whether the earnings will match the valuation. I think that's what the market is looking as of now, where it is structured today. So it is very important to look at corporate earnings from a long-term investor perspective. I'm not going to speak on each and every element, but I'll pick up the couple of callouts, which is very important from a longer-term perspective. So inflation is under control. Our deficits look. A couple of slides later, we'll speak about one or two things around the twin deficits. We have fairly stable currency, and the GDP growth also looks very interesting. So that's where we are in terms of our macro backdrop. Okay, let's go to next slide. So if you look at from a growth economy perspective, where India is growing, if you look at the longer term chart, when we look at current year estimate of FY29, we are aimed to be at 5.7 million trillion, 5.7 million trillion economy in that sense. If you look at India will be slaughtered in terms of nominal GDP ranking at number 3. That's expectation what is trying to build in. And this is also because of the historical number crunching what we do. So we do think that India is growing very fast. If you look at our nominal GDP, you can see this change what has happened for number of years where India took. And India actually grew pretty fast. If you look at even 2030 estimates, we will grow to 6 trillion in 2 years' time. I think what I'm trying to say is that economy-wise, when you dissect the economy, you may see the pockets of economy not growing. So if you look at the thesis between urban and rural, we do believe that there are green shoots in terms of the way the rural economy is looking today. We do see that there are industries or the consumption patterns of rural is doing much better. In terms of urban, the bigger problem pre-elections was rural. I think India took much more time to come out of the election cycle. Generally, if you look at pre-elections, you will find rural economy doing well. But this time we didn't see that much. But having said that, we've seen now that the rural economy is trying to catch up. More importantly, when you look at urban, the urban consumption is going through a premiumization. So I just wanted to give a number that if you look at India sells almost 30 lakhs four wheelers, and if you look at 40 to 45% of the cars, what they sell is SUVs. So premiumization is generally good for the economy because corporate earnings, the corporate profitability looks much better when you do premiumization, where margins gets uh, much better when you do a premiumization. So I think broad sense that what we are watching from a AMC perspective is that how is rural economy shaping up. I think it's very critical for us to look at, and that's where the real consumption starts. So I think broad sense in the sense that if you look at gross numbers, we still feel that the India is still growing as the fastest economy now, and slotted to be a number three in uh, 2030. I think that's an estimate what, and these are consensus estimate across industry. It's just not from an RMC perspective. I think if you look at economists across the world, been looking at it and saying that India has been growing very fast, and if that's the growth rate what India has, it's India can be at number three position at 2030. So let's look at second next in terms of Indian macros. Can I go to next slide, please? Uh, there are strong revenues are helping the twin deficits. If you look at our GDP percentage, we are 4.5 estimated. I think that's a large change. And it is also, if you look at that we came out from a large null period of COVID. I think India, globally, if you look at and say that during the COVID time, who managed the whole economy well, we can see this as a proof on these charts. If you look at our current account balance, also looking good. More importantly, if you look at our oil imports and service imports, I think these are the two components which actually drives both GDP as well as current account balance. I think it's in much more comfortable positions what we were earlier. What we need to look at from an oil import perspective is that I want to spend 1 minute on this. Is that today I think geopolitical risk is also playing well. India is still an importer, but if you look at US as an economy today, they're self-sufficient. The imports have been almost zero for a US economy. In that sense, I think India is only a larger importer globally. I think that's where the economic imperatives will change going forward. So you do see that we do generally will have a flat curve in terms of oil prices today. Very important to think about is that if you look at any geopolitical issues, generally you'll find these assets like crude oil being very volatile. You haven't seen this time, even though you will see 1 or 2 days of blips, but I think India has managed it pretty well in terms of the crude oil prices today. Uh, let's go to second next slide. Uh, very important to talk about the strong external positions. If you look at our external debt percentage of GDP, which is the lowest compared to other countries, and overall debt to GDP is also India is tracking much better. Our FX is very important. If you look at our foreign exchange reserves, the creation on FY19 to FY24, which is table 3 from this chart, is very clear that we are the highest in terms of the reserves at the moment of time when you compare from 19 to 24. It's very critical thing to look at from the lens of how does the India stack from an external positioning perspective. And you also see in the currency depreciation versus USD over 1 year. I think India is still much more comfortable positions compared to most of the emerging market currencies. So this is on the Indian macros. How does it look like? And we'll go to India from a longer term story, whether Thesis saying that whether it is stacking up or no. I think a very important conversation when if you're looking from a market's perspective. So let's go for the next slide. In terms of the longest story, we still believe that India accounts around 21% of the population by 2023. The biggest advantage for India is that domestic population. I think that is getting much better. We are getting much more formalized population in that sense. We are much more younger population coming to workforce. Uh, I think you've been hearing this. I think this is a good story for India, looking at India as a domestic market. So this is going to be a very critical for us to look at, not only from India perspective. I think it's very important to look at from a global perspective also, that how does this population look like. Some point of time, if you look at China had an advantage, 70s Japan had a larger advantage of the population. I think India is in center stage in terms of looking at how does this population look like, and how does it look like from a 2023 perspective. I think my belief is that India will have 21% of the global population. I think so. So consumption can be a huge opportunity here in terms of way India and demographic population looks like for us. So let's go to next slide. Uh, one more thing, I think it's all known, but I think just wanted to stress on this. The digital infrastructure actually is driving our productivity. I think we all know all these numbers, but I think if you look at the other, from 2014, the other cards have been moved up to 2x. It has become so-called citizenship card. I think it has been done for direct transfers. Uh, the use of the other card has been case study across the world. I think this is driving most of the efficiency in the economy. Very important word is called efficiency in the economy, because if you look at historically, India had huge leakage in terms of direct transfers. I think that's been plugged substantially now. One more important thing is that our smartphone users have changed. Today we have an 5x smartphones. Rise in digital payments. I think everybody is logged in here, maybe digitally strong. I think digital payments is one thing which gets formalized in terms of our economy, in terms of how the economy is going to happen. I think this is one of the key drivers for us to look at transactions across, and making this economy much more formal. I think that's the digital payments playing. Your bank accounts is another thing which Jandan program got driven, and we have an 4x bank accounts across. More importantly is that looking at telecom data. I think if you look at we are the cheapest in the cheapest in the world. Very important is that when I met the largest telecom company, the revenue per client is 218 rupees for them, and the second operator has 298 rupees. Just imagine how cheaper is the revenue per customer. That means how much the average customer pays for the services. So I think in that sense is much cheaper. I think this has led to a large revolution in terms of how people communicate, how do people do digital payments, how people use digital content across. I think this has been a key driver. And if you look at the digital transactions, very important percent of GDP, because this drives formalization, and there is a 10x greater transactions here. I think this is a critical metric to look at when we put an argument saying that how India is getting more formalized. Another story is about how does this government supportive government initiatives. Can you go to next slide? One of the things what we need to look at and say that how does the corporate tax structure look like, because corporate tax structure has clearly bearing on the profitability of profitable corporates, especially listed corporates, where we would come to see what types of tax rates we pay. If you look at India has moved to 22% tax structure, but if you still have to look at concessions given for manufacturing companies, the effective rate of this most of the companies today at 15% corporate tax. I think this is large. This is actually getting reflected in terms of the profits of the organization, and that is reflecting in terms of multiplier effect on the capital markets, and ability for ability to expand market cap has been happening around this, because India had a large regime. I think India started a regime of 35%. Now we have as low as 15% on a select companies, select sectors. But very important to think about is that India has now a broad sense we are at 22% corporate tax structure, which is the lowest. Another important thing is also the PLI scheme, where very important initiative where India was led by a service economy for from 91. 1994 onwards, you see India has been a very largely led service economy. Service economy constitute almost 35 to 40% of the GDP. Today, as we speak today, I think what the government is want to do is on the manufacturing economy, where they want to try to create jobs. I think we've seen that the PLI schemes today covers almost 14 sectors. So I have a couple of examples in terms of how manufacturing has done well. Last year, we also launched our manufacturing fund. It has delivered 40% return CAGR. I think uh, manufacturing is being trust in this economy, and especially given the PLI scheme, given the corporate tax structure, I think they are set to success. So I'll give you a couple of examples, which is the next slide we'll talk about is success of the mobile phones in this country. Mobile production in the country. Let's go to next. Yeah, same slide. Mobile phone in production in the country has seen CAGR of 37% over FY16 to FY23. Just imagine that we were never thought about in days where initial days of the mobile phone that India will export from India. I think you have large plants here, whether it's Samsung or Apple. I think you have huge amount of exports happening. Look at the imports, the percentage of total market value. It is dropped by 95%. So most of the mobile phones are now made in India. This is a classical example where how manufacturing can reduce dependence on imports and create jobs at the ground level. I think this has been a key success. We can speak much more on mobile phones because we did a couple of reports around mobile phones, how what the success stories across the pockets of states, especially at southern states where there's a large manufacturing hub was created for mobile phone productions. I think so. Let's go to next slide. I think next slide also we will speak about the Indian markets in terms of uh, um, our how does it look like, and I will call out a couple of points here. Can we go next slide? So India crosses actually market cap of 5 trillion. We are the fourth largest by market cap. Can we move to next slide? I just wanted to make a thesis around saying that the way I want you all to think about is that uh, the way we're looking at from a market cap perspective is that by 2030, I think our strong belief, our thesis says that it can be a 10 trillion uh, 10 trillion USD. That is strongly by domestic flows and potential of large unicorns coming and listing. So you have a couple of ones coming up this week. Let's think about this. That let me give my experience that when the June 4th, when the election result came in, I think there's a market fall. The mutual fund industry got 20,000 crore flow. So whenever we see the market corrects, the domestic mutual funds like us get larger flows. That means people have liquidity. Second is that faith in the capital markets today. I think that is changed. If you look at over last 8 to 10 quarters, FI have been negative, and this market is supported by purely by domestic mutual funds and domestic investors across. I think domestic flows has become much stronger. I think I'm not putting a theory saying that India is completely decoupled from a global market, but I think one theory what we think about is that India is able to sustain the FI outflows and able to keep the market at these levels. And there is a structural change has happened in terms of how the Indian domestic savers are today. I, we've been speaking about it. I think in some forums I have made comment that is a real structural change that the first investment for a investor today is not bank deposit. It is a first is an SIP. I think that is changed. The saving structural changes happened. Hence, you will see a lot of domestic flows. Second important thing, what we've seen across is that when we see the traditional investments like uh, Indra Vikas Patra, post office schemes, all these schemes are getting matured. The customers are not renewing it, and they are coming to capital markets either through a direct stocks or through a mutual fund route. And you also seen the recent numbers, quarter-on-quarter numbers of these banks. They do find difficult in terms of creating deposits. Uh, that year is different, but what I'm saying is that there is a structural change in terms of the way investors are looking at the Indian savers are not more no more savers; they have become investors. I think that's keeping this liquidity on in the markets today. So let's go to next. So we spoke about it in some form or fashion, which I covered here. I think one of the factors which is we have a resilient macro landscape, which we spoke about earlier slides. We also spoke about robust corporate earnings. Having said this, which is my disclaimer here is that we need to watch quarter two earnings. Quarter one earnings is not at the expected lines, but I think markets have looked at it in a different angle. I think if the corporate earnings doesn't look good, I think we will have a time-based correction. I'm not saying that it's an immediate correction, but I do feel the markets will remain much more volatile. Markets will have a valuation correction happening across. So I think, in my belief, the corporate earnings. In few sectors there are challenges, but I think broadly corporate earnings uh, should be able to hold on. But we need to watch and see what's happening on the corporate earnings, which will start off. We already started off now, but I think we still believe we still have the domestic equity flows. We spoke about enough why it is. Um, so if you look at Indian markets, it is in our 30%, large cap index and small cap index at 15%, and in the last 12 months. I think this is real. I think a lot of people ask me this question saying that you've seen the small caps doing well, mid caps doing well, why the large caps are not doing well. If you look at historical numbers in terms of earnings, the small cap companies, part of the small cap index as well as mid cap index, have delivered better earnings, and they're able to uh, sustain the earnings, and hence the valuation was getting much more trickier in these two spaces. Large cap companies, you had some challenges in a couple of packs, which is technology and banking to some extent. You do find the large cap earnings were not to the mark what the markets were expecting. Hence, the lot of flow of money came from to mid and small caps. And a lot of people thought that small cap is largely frenzy. To some extent, yes, there's a valuation stretch. But having said that, in quality companies in both mid and small have sustained earnings. Hence, the valuation looks fully accounted for in that sense. So let's go to the next slide. We spoke about domestic investors getting larger. I think uh, it continued to do that. I just wanted to put some numbers. The SEBI flow for a month is almost 24,000 crores. Very important flow which coming to through a very systematic investment plan across. Uh, we do see that the SIP average tenures have really gone up. That means it gives a sense that the customers are investing for a longer term, and we have seen in portfolios that customers are able to generate a fair amount of returns in their portfolios. So I think there is a faith. I think this is a good sign. If you look at from um, 16 onwards, how does this SIP flow look like? I think more and more investor coming in. We do see that the flow should remain at these levels. In fact, whenever we do our large NFOs, we do see a huge amount of participation across uh, across the client base. Very important to see that most investors today also is coming from B and C class cities through digital mode. The platforms like any fintech platforms like ASL, you do see large amount of participation coming from these platforms. I think Another thing about why the SIP flows looks good is that ease of doing SIPs in all the platforms. I still remember when I started my SIPs in 2005. I think we should have done through a physical mode, and we used to go to a IMC office or to a bank to get registered. I think it was a very painful process. But I think digital is one of the areas which has made life much more easier. Uh, I think that's one of the growth drivers across where all the digital platforms across controls almost 60% of the SIPs. SIPs. So I think you continue to see the flows from large platforms like ASL coming in here. I think you do see a lot of flows from the younger generation participating in the SIPs. So the good news that we've been saying that invest early. I think some portion of our population have got this theory. I think we've been talking about for last decade in terms of how the saver should do and how the saving should do at the early stage of your life. I think that's playing out pretty well for us. Let's go next. I spoke about this thing that high valuations are supported by the earnings growth. I think this has been the conversations in most the medias and most of the research reports saying that high valuations. I think uh, very important to think about is that higher valuations are supported by high earnings growth. So it's critical to see that how the earnings growth looks like. I always said that the market is a slave for earnings. So a lot of people discount earnings. I think what is important to look at from a valuation perspective is that how the earnings shapes up. Very important to support the market. So quarter two is very critical. So let's hope that large companies will have a better results in terms of earnings. I think then we'll able to see the market supporting at these levels. So what do you do in terms of strategies given this market scenario? Looks like global scenario is one thing which I not spoke about. I think the two things which is very important to look at is about interest rates. The interest rates globally is coming down. I think post-COVID, a lot of economies printed notes. They need to cover inflation. Interest rates was all-time high. I think globally interest rate scenario is getting much more benign. It's in a downward trajectory. Having said this, we have a post-COVID. I think there's a new reality in terms of geopolitical issues. I think that will continue to play uh, much more than what it is today. So what I'm trying to say is that markets will remain volatile. Uh, so it's very important to us to think about uh, how do you look at this market and how do you play this market very effectively. I think that's what I'll speak about in the next slide. Um, that one important thing you need to look about is asset allocation. I always said that the two things to think about asset allocation is that you need to look at your risk profiler and you need to look at your asset allocation. Very important to look at because both are interdependent. I think a lot of people do risk profiling and they do believe that asset allocation is not important. Knowing the risk profile is very important to match with asset allocation. I think it's very important to look at together. So you will have an key investment thesis in India is equities. Either you want to play through a direct equities or through a mutual fund. Another areas to look at is fixed income, whether you want to play through a bank deposits or through a mutual fund route. And you need to look at how can you play commodity cycle, right? Whether it's gold and silver. So most of the time when you look at these geopolitical issues, just wanted to point here is that you also see that risky assets generally gets corrected and the money goes to safer havens. I think so. A lot of people believe that when there is a geopolitical issues, the best place to hide is to buy commodity cycles, right? Especially gold. I think that's one way to look at it. But my view is that you need to make sure that you diversify your portfolio as much as possible, so that going from here you will have huge amount of volatility. And how do you maximize your return is your objective, and make sure that your risk levels what you take matches with your risk profilers. So a couple of things to think about when you're looking at asset allocations. Critical is to look at age, lifestyle, risk appetite, and investment horizon. I think if you are in these markets, I think your investment horizon has to be from 3 to 5 years. to generate meaningful returns. Let me tell you that. Let me stress that it's meaningful return, because today's whole thesis which I'm talking about is long-term investments. Longer term investments, I think you need to look at 3 to 5 years. Nothing wrong for direct investors to do some. I always said that there's some portion of investors come to the markets to have so-called thrill. I think they continue to have that thrill by doing day trading. I think that is not investments. Let me tell you that. A lot of people think that when I do intraday, I do an F&O, I hold stock for 3 months and churn. I'm a long-term investor. I think it's quite untrue. The long-term investor, when you look at the compounding impact, whether through SIP or through lump sum, will come only after 3 to 5 years, and that's where it's a meaningful return for a portfolio. I think so. We need to differentiate between trading mindset and the investment mindset. I think these are the two different mindsets. Just wanted to keep you guys in this thought process. Can we go next? So this is one thing which you wanted to think about is that when we talk about which asset class to perform, if you look at from historical data from 2013 to 23, I plotted 10-year data. If you look at varied period of time, varied instances, you will find different asset classes doing differently. This is a very interesting slide which I speak about for some point of time, but I think today lack of time, I think I will keep it for some other time to spend more time on this. So winners actually rotate here. So I think you just wanted to have this slide, or if you want this slide around, you can ask Samir may send this. Is a very interesting slide to look at what happened to different asset classes and how does the return look like. So this one time, I think in terms of a longer term investment, I'm coming back to the same thesis. You have an opportunity to look at, good next slide. You can look at from a fund perspective, from an investment perspective, I think you have these 5 types of core allocation, and you can also look at thematic allocation. Thematic allocation is also very important to think about, is that how do you approach the market with a theme, and how can we build portfolios based on theme. So 2 themes which we built on for last 1.5 years is that one on manufacturing, and recently we built a theme on consumption, and both are largely diversified by nature in terms of how we built a portfolio, but it's an approach towards markets, because one is to go sectorially, one other is go through a market cap route to approach markets. We do think that alphas can be generated by approaching the market through a thematic approach. And we don't do narrow themes, but we are much more broader themes, which are much more diversified in terms of portfolio. And both approaches have fairly done well, because manufacturing has done well, consumption is just building up for us. It's also delivered fair amount of good performance, but it has to go through the test. It's still just a 1 month old, so it has to go through the test of the portfolio. But the build quality, build construction of the portfolio looks very interesting here. The last slide we will talk about, last 2 slides we will talk about is on the build on volatile times. I think we spoke about it. So I'll just skip this so that I don't repeat again and again the same subject which is there. So in terms of longer term investment, next slide, you can think about, I just wanted to put a slide which I thought is appropriate, which is next slide, which is how do you think about for a longer term strategy? Is there any other methods to approach through a fund strategy? I think we can also look at hybrids. When you look at hybrids, you need to also look at from a return potential versus perceived risk, because it has got multiple asset classes on one fund. And some point of time, some retail investors use this method because they don't want to do an asset allocation call. This call can be done by fund managers. So this one thing which is also getting much more prominent by retail investors. It's one way to think about how do you give the asset allocation to a hands of fund manager, let the fund manager do the allocation between equity and debt, and you have a broad choices of 5 funds we can decide, and based on the market call, the fund manager is able to take a call. And as long as you can match your risk profile here, and the life becomes much more easier to take a call here. The last slide, value added, I just wanted to think about this is that a lot of people know about SIP. People do know about STP because these markets, if you have to come to mutual fund route, and I still suggest people that don't look at a one-time investment, do an STP so that their averages looks much better. And then the compounding can come later. I think very important to do an STP because markets are being volatile. I think volatile markets or a linear markets upwards, which I do personally suggest people is to do an STP. And very important also to look at how do you do a withdrawal plan systematically. I think a lot of merit, lot of content is available in the social media in terms of SWP. I think these are three the modes of how do you want to put money and manage money. I think that's all from my side, and quickly I can take a couple of questions if it's there around. I would like to avoid only stock specific, but rest of the answer questions I would like to answer. I'm open for any conversations around it.
Thank you so much, sir, for your very informative session. Sir, we have got couple of questions on our YouTube channel. First one is from Varun. He asked which industry, according to you, are facing tailwinds.
So two or three things. I think if you look at purely from a sector perspective, I think if you look at last 5 6 quarters and you look at which are the sectors didn't do well. I think if you look at from a valuation comparison, I'm against stressing valuation comparison, we still find IT and banking pack is looking is not it has not got the valuation as much what the market should. I think these are two sectors actually didn't do well on the market run. And if you look at their return contribution on the overall Nifty pack, also you'll see the drag there. Having said that, let me also give you some thoughts around. Uh, mm, Let me give some thoughts around how the market is looking today. The market was very broad based. If you look at last 5 6 quarters, market was broad based. When I said broad based, it means that every stock did run whatever, and people find it very easy. Where people money making was very easy because money when the market becomes broader, you will see that, and you also seen the reflection in the most of the mutual fund portfolios where typically when we used to run a 60 stock portfolio, we started running at 90 95 because markets become broad based. You are capturing the alpha becomes much more difficult. When I said alpha, how do I capture the returns? So it becomes very broad based. But if you look at last 45 days, the market has become much more narrow. So what does it say is that market is going through a contraction. When you look at contractions, where very important to look at is that two things will play very important. One is quality index and the growth. These two prominent styles will play. So this has been happening. So you look at maybe the portfolios which is released in month of September, you'll see that number of stocks owned by mutual funds have gone down now. It becomes much more narrower. So that's how the markets tend to become much more stock specific, and we have seen that, and we have. It's just not our portfolio. When you look at portfolios of other AMCs, also you will see this change. So market is getting much more narrower, and market become very difficult in terms of stock selection. So I think that's what I want to say. Sorry, I just had a long answer for this, but I thought it's appropriate to address in terms of what does the market look like in terms of the width.
Yes, sir. Thank you so much, sir. It was really insightful, and it will definitely help Mr. Varun. Sir, another YouTube viewer, his name is Wanderer. He has asked one question. Sir, I am a new investor to the market, and I am little hesitant to enter the market due to current market situation. What is your suggestion for me?
What I learned for last, I worked for 30 years. Out of that, 25 years I spent time in capital market. 23 years exactly, and substantial portion of my career went in capital markets business. And I have seen 5 cycles. One thing is very important that you can't time the market. If you are a long-term investor, please don't time. What is important is that how do you want to approach the market and how do you want to approach the equity as an asset class. Very important to think about it. So if you are looking at from a market in terms of if I am a first time investor, do not have an experience in the market, better that you think about, can I allocate money to a mutual fund? Let the fund manager take a call of building a portfolio for me. Uh, so I always believe that market timing is not important. I think as long as you do STP. So if you have if you have, for example, lack of rupee, you can make sure that you can put in 6 months or 8 months or even 10 months SIP, or where the denomination as less than 500 rupees. What I'm trying to say is that you need to have very clear longer term investment objectives. Then your life becomes much more easier, so the market timing becomes less relevant in that case. So very important to think about this. So my question is that don't time the market, spread your investments for 6 to 12 months. You will really see the compounding catching up, because nobody can time the market. Even the best of the best pundits in this market can't tell you that markets at the higher rates.
Yeah, sir, thank you so much. And there is another question from Mr. Nagathan. He asked, does STP attract tax?
Yeah, STP will not tax. Obviously, if you move from a liquid to equity fund, there is small component of that happens. But I think when you look at the returns from a equity market perspective, I think what you pay in India is an negligible tax. So I always said that when you approach, a lot of people approach investments in the broad sense when they buy a product, whether it is an insurance product or a liquidity product, from an angle of tax. I think what we need to look at is that we need to look at the merit of the product and how the product can deliver returns. I'm not saying that we should not look at the post-tax returns. Very important to look at. But having said that, let me tell you that the recent last 2 years, the finance minister's ministry and this budget has clearly clarified, saying that it's going to become much more product agnostic, in the sense that they don't want to differentiate between the different products. So you will have a regime very shortly that all investment products will have a similar tax structure. So when you have that and is already in play, 70 to 80% of the investment products today almost have become similar in the tax structure. So what is important to say is that how does the merit of the product will work? I think that's what you need to think about it.
Sir, can we take another question?
Yeah, sure. I can do more. No worries.
Yeah, sir. There is one YouTube viewer, Mr. Prem. He has asked one question. What is your view on future of money market in the coming years in terms of safer investments?
So I think one you can look at is that we are in the situation when I spoke about global interest rates in the downward trend. So India will also go through it. I think India also should have. Our forecast is that third quarter we'll see some interest rates cut. The scenario will become such a way that you can think about interest rates in India at 6.5%. That's what the trajectory India will look like. Having said that, how do you maximize your capital preservation? When you talk about money market instruments and investing in money market instruments, you are coming from a clearly saying that how do I preserve capital and preservation capital, and how do I maximize my return? I think there are two things trajectory. I think in my view is that there is an opportunity where you can just straight away go and put the money in FTs, which you you'll get matched with what are the interest rates in the economy is today. But if you want to play a safer game with a bit of a flavor of equities, I think my belief is that hybrid schemes are the good schemes to look at and say that how do I want to play this longer tenures. When you look at a pure money market products without any equity linked, I do still believe that there is a problem. And this problem in the sense that uh, you will you will be nearer to the inflation number, but not beating the inflation. So idea is that when you look at from a financial planning perspective, Ideally, what we need to look at is that from a whole portfolio perspective, you need to beat inflation, right? The inflation is what bites us. Traditionally, we have seen like 30 years inflation. It's a very killing one for most of Indian citizens. So inflation is very critical. So in my belief is that you need to think about a couple of hybrid schemes which will tell you what type of risk you can take, and lesser risk your returns gets moderated. So there are products which will give you fixed deposit plus 1.5% return. I think that's one thing you can think about. But from interest rate perspective, it will become much more benign, and India is heading to a lower interest rate scenario.
Sir, there's one question. He is asking, like, no, how should investor approach asset allocation when building a mutual fund portfolio?
Clear. I think one is you need to go through the risk profilers. I think very critical to look at risk profilers. And second, the risk profiler also need to match with your financial plan. I think most of the people will have a financial goals. Based on that, you can start allocating the mutual funds. Typically, in my belief, is that how to play a good mutual fund portfolio is that what it was 10 years back is not the same in terms of what products are available in the country today. Broadly, if you, I always suggest people that you can't have more funds in your portfolio. Think about, but please do your risk profiler and financial planning. But I'm saying the broad sense, you can look at a couple of allocations in large caps, combination of mid cap, and try to build some exposure on the passive funds. Very critical to look at how to use your passives, and that's how to be the broad in terms of a framework wanted to play in terms of how do you want to build a portfolio. Very important to think about it, but offhand, I'm not able to give you a solution saying that okay, you just invest in these funds, your life will be okay. What I would like to see is that how is your risk profiler, and I do have a candid conversation in terms of your financial planning and goal planning, and then drive an asset allocation and work on your asset allocation through a mutual fund route. It's possible. I also suggest that there are platforms, there are good advisors in the market. You take a good advisor, he'll be able to suggest you comprehensive plan in terms of how to build a portfolio.
Sir, it was a really very candid reply. Sir, we'll take one last question,
Yeah.
and that is coming from Muzaffar. Sir, he's asking your input, sir, on weight between large cap and mid cap in the portfolio.
So, for example, let me give you a couple of things which are large funds for us. Very clearly, if you look at our blue chip fund, the blue chip fund is true to label for us. So, if you look at our fund performance, you may see that we are not up the stack, but very clearly we are 94% of our portfolios are blue chip stocks. We don't use mid and small in a large cap because we are strongly believe that if your money is given on a blue chip fund, we'll invest in a blue chip stock. If you look at comparatively other AMC products in the blue chip category, you will find mid and small there. That is one to look from a large cap perspective. Second, very clearly from our, including our small cap, if you look at our 20% allocation, which the regulator allows us, we have some allocation to mid and large. So we are very true to label in that sense in terms of the way we construct our portfolios. We do believe that you're given money for a specific strategy, we will do it. So if you look at from our whole basket perspective, from an active fund perspective in terms of number of stocks and our allocation, my belief is that we are largely AMC managing large amount of money in large and mid. So if I had to put a number, I think we should be 65% of our overall portfolio is in the large cap. Let me give an example. Another is the bigger fund, which is Flexi Cap. Our Flexi Cap runs at 65% large cap as of now. Multi cap is another category which we do. We've been number one fund for consistently now, where 50% is large, 25% is mid, and 25% is small. This is how it looks like as of now. We've been there in the large caps nowadays.
Yeah, sir, Mohit Ajwani is requesting one question. If time permits, then can we cover?
Yeah.
Sir, he is asking question that what is better investment on your own or via mutual fund route, since mutual fund like hybrid and multi assets are very high commission.
Come back to the question. I'm not able to
Sir,
understand.
yeah, what is better to invest on your own or via? He's asking basically, should he take a direct
Okay. Okay.
direct
I
equity
think
route or
there are
mutual
two
fund route?
schools of thoughts around here, Samir. I think I didn't recollect the name who asked this question, but I just want to answer is that there are two thoughts. My belief is that if you are an expert, you are able to manage the portfolios. The cost effective way is to make sure that you invest through direct. No problem with that because I ran a brokerage firm for 23 years. I have seen different types of investors, but I think only not even 1% of the customer base which I used to operate understands how to build a portfolio because you tend to get swayed away because of returns or a fear of market where you book losses. All these things happen. So I think what is important to build a portfolio is discipline. I think what mutual fund brings is that, and there is a cost attached to that in terms of building. As we speak today, the way it looks like is that if you're a longer term investor and the way the expense ratio looks like, I think today, um, if you look at any, it's all now with regulated with SEBI regulation. There is no excess what we charge to a investor, but both has pluses and minuses. But my belief is that if you are a disciplined investor, you know how to construct a portfolio, and you can build a longer term portfolio. I think it's better to do a direct. But um, if you're not expert and you want to outsource that to a fund manager, there is a fee what you pay. But my experience is that the benefit of paying a fee and your returns are commensurate to that what you pay. I think that's what I want you to think about it.
Sir, thank you so much, sir. It was truly an insightful session. To summarize, sir, you have covered macroeconomics factor, highlighting that India is one of the fastest growing country. Also covered rural consumption is on the rise, and our external debt to GDP ratio is among the lowest. Additionally, sir, you have provided a lot of information about long term perspective, how digital infrastructure is driving productivity. And sir, you also covered that like no, just because of our digital infrastructure, the relative like no, the cost is also going down. And even sir, you have covered like no, lot of support is coming from domestic player, and they have become the much more stronger than before. And you have also nicely covered about the importance of asset allocation and many more things, which was really useful tips for an investors. So this information has instilled a lot of confidence and clarity regarding the long-term economic output amongst investors, sir. And sir, thank you for gracing this webinar, and I'm sure, sir, we'll be doing a lot of such informative webinar in future. And thank you so much, guys,
Thank you
for
so much.
patient. Yeah, sir, and thank you so much, viewers,
Thank you.
for spending time from your busy schedule.
Thank you. Thanks for hosting me. Thank you so much. Thank you.
Thank you, sir.
Thank you.